Welcome back to the Daily Crypto Roundup. Today we've got a proper mix of fear, infrastructure, and institutional positioning to get through. Because while the market itself has clearly been under pressure, there are still a lot of developments underneath the surface that matter if you're trying to understand where crypto goes next. We're going to be looking at the market moving deeper into fear territory, the scale of the wipeout across crypto, why Bitcoin has still managed to hold up better than some people expected against more traditional assets, Wells Fargo stepping further toward stablecoins, Ghana selecting 11 crypto firms for its sandbox pilot, MetaMask integrating the Uniswap API directly into its swap stack, USDC continuing to build toward a major market cap milestone, and the latest XRP angle around buybacks and tightening exchange supply. And now for the XRP giveaway results. First off, just a quick thank you to everyone in the community. The support, the comments, the engagement. It genuinely means a lot, and it's what's helping grow the show into what it is. Today, we've got Andre Legal picking up 10 XRP and Catherine Sid getting 5 XRP. So congratulations to both of you. If that's you, drop your wallet address in the comments below. Include a memo if required, and we'll get that sent over to you. For everyone else, stay involved, keep supporting, and we'll keep running these giveaways as the channel grows. The first thing to say is that this market still feels heavy. Even if we don't want to recycle yesterday's Bitcoin below 70,000 line too much, the reality is that the broader move still matters because it sets the tone for everything else. What changed over the last day wasn't just price. It was mood. Traders have become more cautious, the market has become more defensive, and the sense that risk is being pulled back has become much more obvious. We are not in a carefree melt-up environment right now. We are in a market that is trying to decide whether this is just another reset or something that gets uglier before it gets better. That is why the fear angle matters. When people hear extreme fear, they sometimes treat it like a meaningless headline, but it is actually useful if you know how to read it. Extreme fear means that traders are getting smaller, conviction is slipping, and people are no longer assuming every dip is automatically a gift. It changes behavior. It changes how aggressively people buy. It changes how much leverage they're willing to use. It changes whether they sit through volatility or panic out of positions. And once that psychology changes, price can move far faster than people expect. That takes us to the size of the move itself. Roughly $100 billion being wiped out of the crypto market in a short period is not just a dramatic figure to read out for effect. It tells you the market is still fragile when liquidity gets pulled back. A big wipe like that means money is moving out of risk, but it also usually means leveraged positions are being forced closed. That is where named analysts are useful because it stops the whole thing becoming vague hand-waving. Marcus Thielen of 10x Research has repeatedly framed these sorts of episodes as market structure events rather than some deep collapse in fundamentals. That is a key distinction. In other words, what often breaks first in crypto is not the long-term thesis, it is the positioning. And that is exactly how this move feels. It feels like a market that leaned too hard one way, then got smacked by macro conditions and had to unwind quickly. That is a very different story from saying the whole sector is suddenly dead. You can have a bad price move and still have an intact long-term infrastructure story. In fact, crypto has done that repeatedly. Thielen's line of thinking is helpful because it reminds people that short-term pain often comes from how the market is positioned, not from some sudden discovery that blockchain has stopped mattering. Macro is the next piece of this, and again, this is where named people matter. Matt Hugin at Bitwise has been one of the clearer voices on this wider issue for a long time. His basic point is that in the short term, crypto is still a macro asset. That means if liquidity tightens, if the Fed stays restrictive, if oil is pushing higher, if broader risk markets wobble, crypto is going to feel it. And that is important because it stops you making the mistake of hunting for a purely crypto-native explanation every single time the market rolls over. Sometimes the answer is not a protocol problem. It is just the fact that money is getting more cautious everywhere. Now, before we move further into the infrastructure side of things, this episode is sponsored by NordVPN. And this actually ties directly into what we're talking about today. Because when markets get volatile and activity picks up, security becomes even more important. If you're trading, moving funds, or even just checking your portfolio on public networks, you are exposing yourself more than you think. A VPN adds that extra layer of protection by encrypting your connection, keeping your data private, and reducing the risk of being targeted. The reality is, if you're in crypto and you're not using something like a VPN, you're leaving a gap in your setup. It's not just about convenience, it's about protecting your assets. People focus so much on wallets and exchanges, but forget about their connection itself. That's where something like NordVPN comes in, and it's one of the simplest upgrades you can make to your overall security. Link in the description if you want to support the channel. Now, moving back into the market itself, one of the more interesting dynamics right now is how Bitcoin is behaving relative to traditional assets. Despite the broader weakness, Bitcoin has shown moments of relative strength against gold, and that's starting to bring back the conversation around whether Bitcoin is beginning to act more like a macro hedge again. Noel Acheson has pointed out that Bitcoin's relative strength versus traditional hedges is starting to re-emerge, although it's still inconsistent. That inconsistency is key because it tells you we're not fully in that new regime yet, but we are seeing early signs of it. On the institutional side, Wells Fargo stepping toward a stablecoin product is one of those developments that might not immediately move price, but matters over time. When a bank of that size starts exploring stablecoin infrastructure, it tells you that traditional finance is not ignoring crypto. It is building around it. This is how long-term adoption happens. Not through hype cycles, but through slow, deliberate integration into existing systems. At the same time, you've got global adoption continuing to build out. Ghana selecting 11 crypto firms for a regulatory sandbox shows that governments are still actively exploring how to integrate digital assets into their financial systems. These types of programs allow regulators to test frameworks, understand risks, and build systems that can support wider adoption. And often, these emerging markets move faster than larger economies because they have more to gain from alternative financial infrastructure. From a product and usability perspective, MetaMask integrating the Uniswap API is another step forward in reducing friction for users. Joseph Lubin, one of the key figures behind Ethereum and Consensus, has consistently pushed the idea that usability is the biggest barrier to adoption. Making it easier for users to interact with DeFi, swap assets, and move through ecosystems without complexity is what drives growth. This integration does exactly that. It simplifies the process and brings more functionality directly into the wallet environment. Alongside that, USDC continuing to grow toward a major market cap milestone reinforces the idea that stablecoins are still the backbone of the crypto ecosystem. Jeremy Allaire, CEO of Circle, has spoken multiple times about the role of stablecoins as the bridge between traditional finance and crypto markets. And that's exactly what we're seeing. As USDC grows, liquidity improves, settlement becomes easier, and the entire ecosystem becomes more efficient. Finally, we've got XRP, which continues to stay in the conversation. Whether it's through buyback discussions, supply tightening on exchanges, or broader speculation around its role in financial systems, it remains one of the most talked about assets in the space. Brad Garlinghouse, CEO of Ripple, has consistently emphasized the role of XRP in enabling faster, more efficient cross-border payments. And regardless of short-term price moves, that narrative continues to keep XRP relevant in both retail and institutional discussions. So when you step back and look at everything together, what you've got is a market that is clearly under pressure in the short term, but still building in the long term. You've got fear increasing, liquidity tightening, and positioning being reset. But at the same time, you've got institutions moving in, infrastructure improving, and global adoption continuing to expand. And that's the balance you need to understand. Because if you only focus on the red candles, you miss the bigger picture. And if you ignore the short-term risks, you expose yourself unnecessarily. Right now, both matter. This is a market that requires discipline, awareness, and a clear understanding of what is actually driving these moves. As always, drop your thoughts in the comments, smash like, follow, and we will see you at the top.